Silver is not moving because of a headline. It is moving because incentive structures, industrial demand, and funding conditions are aligning at the same time. And when those mechanisms align, price can travel further than most equilibrium models expect. From our strategy perspective, we begin with structure, not targets. The discussion highlights three transmission channels. First, industrial demand tied to electrification and artificial intelligence infrastructure. Second, compression in the gold to silver ratio suggesting relative repricing. Third, the potential for short covering to accelerate momentum. None of these are predictions. They are mechanisms. Silver today is no longer primarily a monetary asset. Roughly two-thirds of demand is industrial. That changes elasticity. At the same time, a significant share of global supply is produced as a byproduct of lead and zinc mining. That means supply does not instantly respond to higher prices. When executives reference expansion incentive levels in the $30 to $35 range and all-in sustaining costs near $20 to $22, what they are describing is margin convexity. Above certain thresholds, operating leverage expands quickly. But convexity works in both directions. In our strategy framework, that is late phase 1 behavior. Liquidity is supportive. Capital markets reopen. Banks begin calling again. That detail is important. When bankers initiate contact, it signals funding receptivity returning to the sector. That is not sentiment. That is liquidity transmission. The critical issue is durability. Sustained pricing north of $50 changes capital budgeting decisions. It moves projects from optional to executable. However, financing hundreds of millions or even billions in capital expenditure requires stability, not a short spike. Markets often confuse spikes with structural repricing. Industry operators do not. At this stage, we would characterize silver as late phase 1, with rising phase 2 volatility probability. Phase 1 continuation into mid-2026 carries roughly a 60% probability if real yields remain stable and credit spreads remain contained. A meaningful retracement toward incentive zones carries roughly a 30% probability over that same horizon if term premium rises or the dollar strengthens materially. A broader liquidity event that pressures commodities simultaneously carries roughly a 10% probability and would likely be policy-sensitive and reflexive. If this type of phase-based, mechanism-driven analysis helps you think more clearly about markets, consider subscribing. The goal is not to follow forecasts. It is to understand how liquidity, credit, and incentive structures interact so you can interpret volatility with context rather than emotion. Confirmation for continuation would include stable or declining real yields, contained high-yield spreads, and sustained industrial demand strength. Invalidation would include widening credit spreads, a sharp rise in long-duration yields driven by term premium expansion, or persistent dollar strength tightening global liquidity. This discussion is for educational purposes only and reflects probabilistic analysis, not investment advice. Silver today behaves as a hybrid liquidity asset with industrial torque. That makes it powerful in supportive regimes and volatile when funding conditions shift. We will continue monitoring liquidity, credit conditions, and incentive thresholds rather than anchoring to price targets. Optionality over conviction. Mechanisms over headlines. That remains our strategy.